Welcome to our explainer on Dow Theory. For well over a century now, investors have been using this framework to try and find some kind of order in what can feel like the total chaos of the stock market.
So here's how we're going to break it down. We'll start by digging into that feeling of market chaos. Then we'll get into the core ideas of the theory, like market trends and phases. After that, we'll look at how to actually apply these ideas. And finally, we'll talk about how relevant it all is today and what the biggest takeaway is for you.
All right, let's jump right in with the big fundamental problem that honestly, every single one of us faces when we look at a stock chart.
Yeah, this gets to the very heart of why investing can feel so darn unpredictable. I mean, one minute there's total euphoria, and the next it's just sheer panic. How are you supposed to navigate that kind of emotional whiplash?
Well, this is exactly where Charles Dow comes into the picture. What's so interesting is that he wasn't trying to cook up some magic formula to beat the market. No, his goal was way more practical. He just wanted to create a framework, a set of logical rules to help investors stop making those classic mistakes that are driven by pure, raw emotion. What's really cool is that Dow is a financial journalist, not some Wall Street trader. Back in the late 1800s, through all his work, he pretty much laid the groundwork for what we now call technical analysis. He had this core belief that the stock indices, the big averages, could actually tell us a story about the health of the entire economy. Okay, so now let's get into one of the most powerful and honestly intuitive concepts in the entire theory, the idea of the three market trends.
So, Dow's big idea was this. While the day-to-day price swings might look like pure random chaos, they're actually part of much larger identifiable trends. And to explain this, he used this absolutely brilliant analogy that we still use today, the ocean.
This is just such a perfect way to picture it, right? The primary trend is the tide. It's the most powerful long-term force telling you if the market is fundamentally going up or down. Then you have the secondary trends. Those are the waves. They're just temporary corrections that move against the tide. And the minor trends? Those are just ripples. They're the daily noise that's basically designed to distract you. Dow's big insight was to teach us to focus on the tide, not get lost in the ripples. But Dow didn't stop there. He also noticed that every primary trend, whether it's going up or down, seems to follow this predictable life cycle. It has three distinct phases, and they're all driven by investor psychology. So for this explainer, we're going to walk through the life cycle of a bull market, which, as you know, is just a fancy name for a primary uptrend. This whole cycle is really about how information and emotion flow through the market. So it starts with accumulation. This is when the really smart, informed investors start quietly buying stocks when pretty much everyone else is still pessimistic. Then comes public participation. This is when the trend becomes obvious, the news gets all positive, and the general public finally jumps on board, which is what really drives prices way up. And finally, you hit the distribution phase. This is where those smart, early investors start selling their shares to all the enthusiastic latecomers, right when hype and speculation are at a total fever pitch. Okay, so if we know what these trends and phases are supposed to look like, how do we actually identify one with any confidence? Well, Dow gave us two really important principles for confirmation. Dow's insight here was just brilliant, common sense stuff. He said that for a trend to be the real deal, the major market indices have to agree with each other. Back in his day, that meant the industrial average and the transportation average, which was mostly railroads then, had to be moving in the same direction. The logic is so simple. If factories are making more stuff, then someone has to be shipping that stuff. The two should move together. So this principle is like a critical safety check. If the industrials are hitting new highs, but the transports are kind of lagging behind, that's a huge red flag. It might mean that even though goods are being produced, they aren't actually being shipped and sold, which suggests the economic strength might just be an illusion. The second piece of confirmation comes from trading volume. Think of volume as the fuel in the tank for a price move. In a healthy bull market, you want to see volume explode on the up days and then kind of dry up on the down days. That shows real conviction from buyers. But if you see prices drifting higher on a really weak volume, that's a huge warning sign that the trend might be running out of gas. Now, all this stuff has been incredibly influential, but let's be real for a second. Dow theory was developed over 100 years ago. The world of steam trains and telegraphs is, well, it's long gone. So the big question is, how does this stuff actually hold up today? And yeah, there are some really valid criticisms. For one, because you're waiting for confirmation, the signals can be late. You might miss a big chunk of the move. Second, focusing on just industrials and transports feels a little outdated in our modern tech-driven economy, doesn't it? And finally, a lot of this is subjective. Two analysts can look at the exact same chart and see completely different things. So it's a powerful tool for thinking, for sure, but it is not a crystal ball.
But here's the thing. Despite its age, despite all those valid criticisms, the core lessons of Dow theory are absolutely timeless. They are just as valuable for us today as they were 100 years ago. So what are the big takeaways? First, markets aren't totally random. They move in trends. Second, never act on just one signal. You always want to look for confirmation. Third, pay close attention to volume. It tells you about the conviction behind a move. And finally, be patient. A trend is in effect until it has clearly, obviously reversed. Don't let the daily ripples shake you out of a strong tide. And this quote from Warren Buffett just perfectly captures why all of this still matters so much. This idea of a perfectly rational, efficient market, that's just a fantasy you read about in textbooks. In the real world, markets are driven by human psychology, by fear, and by greed. And those are the very forces Dow theory gives us a framework to understand. And that brings us to what is probably the most important point of all. The theory's greatest value isn't in trying to predict the future. It's the discipline that it forces you, the investor, to have. It makes you be patient, it makes you wait for confirmation, and it makes you think logically about the big picture instead of just emotionally reacting to every little bit of news and daily noise. When you use Dow's principles as a guide, you learn to interpret the market in a more structured way, to identify the real trend that's going on, and to make more rational, informed decisions. And in the long run, it's that disciplined approach that truly separates successful investors from the reactive crowd.